For generations, the American dream has been tied to owning a home. But it turns out the way we're financing that dream, well, that's changing in a big way, too. Today, we're going to dive into a huge shift in the housing market, and it's all centered around a new and pretty revolutionary kind of mortgage. For decades, getting a mortgage has been this whole thing, right? A pretty straightforward, if not kinda stressful process. Lenders have a very specific checklist. They're looking for those steady paychecks, those neat and tidy W-2 forms. It's a system that was really built for a traditional 9-to-5 world. So what happens if you're a small business owner, or maybe a real estate investor, or part of that booming gig economy? Your income might be fantastic, but it just doesn't show up on a standard W-2. And for a long time, it really felt like the door to homeownership was just slammed shut for people like you. But that's all starting to change. And it's not a small change either. In fact, if you don't fit that old mold, you are part of a massive, and I mean massive, group. We are talking about a $150 billion market for borrowers who are totally rewriting the rules of home financing. Yeah, this isn't some tiny niche corner of the market anymore. This is a fundamental shift, with the world of finance finally catching up to a new way of working. So to really get what's going on, we first need to meet the people who are at the very center of this change. So first up, let's talk about the forgotten borrower. Who are they, really? Who makes up this huge market that the old system just wasn't built to handle? Redwood Trust President Dash Robinson, he actually puts it perfectly. He calls this a large group of high-quality borrowers. And let's be super clear here, this isn't about risky loans, not at all. It's about financially solid people who just don't happen to fit the standard paperwork. So think about self-employed business owners, real estate investors who are buying up rental properties, and that ever-growing number of gig economy workers. Essentially, we're talking about anyone whose income doesn't come from a predictable, bi-weekly paycheck. Okay, so you've got this massive group of people. How in the world do you serve them? Well, the financial world came up with a pretty specific tool for this, and it's called the non-QM mortgage. It stands for a non-qualified mortgage, or just non-QM for short. Now, the crucial point here, the thing to remember, is that it doesn't rely on W-2s. Instead, it uses other ways, alternative ways, to prove you can actually afford the loan, which opens the door for all those forgotten borrowers we just talked about. Okay, so here's where the rubber really meets the road. The traditional path? It's obsessed with your W-2s and tax returns. But the non-QM path, it takes a way more realistic approach for a modern worker. It looks at the actual money flowing through your business bank accounts or the cash flow coming in from a rental property. It's a common sense look at your real financial health. But lenders, they don't just hold on to these loans. They package them all up for big investors through a process called securitization. Now, I know, it sounds super complicated, but just think of it like making a smoothie. You take hundreds of different individual loans, that's the fruit, and you blend them all together into one big financial product that investors can easily buy. All right, so let's see how this all works in the real world. We're going to look at one company, Redwood Trust, which is making a massive $391 million bet on this exact market with its new platform. And their very first smoothie of these non-QM loans was worth $391 million. I mean, that is not a small test run, right? That is a massive statement of intent. Now, when we dive into the numbers of this deal, we see it's made up of 752 individual loans. But here's the kicker. Look at that average credit score. 754. That's excellent. It just proves these are financially responsible people. And the average loan-to-value, or LTV, is under 70%. That simply means the borrowers have, on average, over 30% equity in their homes. That's a huge financial cushion. So if they're not looking at W-2s, how do lenders get comfortable enough to issue hundreds of millions of dollars in these loans? I mean, what are they actually looking for? What's the secret sauce? It really comes down to two main paths. For a business owner, lenders will look at 1 to 2 years of bank statements to see the actual real cash flow. For a real estate investor, it can be even simpler. They use something called DSCR, debt service coverage ratio. It's a fancy term for a really simple question. Does the rent coming in cover the mortgage payment going out? If the answer is yes, the loan is often approved. So we know who the borrowers are, and we know how they get approved, but why are big institutional investors, the insurance companies and pension funds, why are they so eager to buy these bundles of loans? Well, it really boils down to three things. First, you get better returns. Investors get paid a little extra for moving beyond those standard government-backed loans. Second, there's a lower risk that borrowers will pay off the loan early, which gives the investor a really predictable income stream. And third, all that stability makes them a perfect long-term investment for those big players. And as Redwood's president says himself, investors are actively out there hunting for that risk premium. It translates directly to a better return on their money compared to what they'd get from a more standard mortgage. And that stability is often locked in with something called a prepayment penalty. This is especially true for investment properties because it discourages borrowers from refinancing or selling right away. So for the investor who bought the loan, that means a predictable, steady stream of income. And in the world of big money, predictability is golden. So when you put all these pieces together, the changing workforce, these new financial products, and that big investor appetite, what does it all really mean for the future of buying a home? You know, what's so telling is that even with its billions in volume, Redwood estimates its own market share is only about 5%. This isn't just one company's strategy. They are just one player in a massive $150 billion market that is fundamentally reshaping itself. So what's the real story here? Well, the rise of the non-QM mortgage isn't just some boring financial trend. It's a direct reflection of our evolving economy. The world of finance is finally catching up to the fact that millions of Americans don't earn a living from a traditional 9-to-5 job anymore. And this leaves us with a pretty big question. As our economy continues to shift away from the classic 9-to-5, are we seeing the beginning of the end for the traditional one-size-fits-all mortgage? Well, the market is betting hundreds of billions of dollars that the answer is yes.